Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young. Now, going back to a few weeks ago when the market was straight vertical for most of 2024, we tried to slide in a few of our videos that this is not normal. There is going to be a correction at some point. Think back to even last year, 2023, which was such a great year for the markets. The S&P 500 up over 20%. The international markets and small and mid-cap stocks up over 14%. And yet, do you remember August, September, and October? There was a 3-month stretch during 2023, a great year for the markets, where we took a dive over 10%. And again, a year that was so positive. The market is falling right now. And by the way, how much it has fell? Well, the market topped out with the S&P 500 this year being up over 10%, the MSCI EFA international stocks up nearly over 6%, and small and mid-cap stocks up over 4%. To today, the S&P is only up 4%, falling nearly 6%. The MSCI EFA is up only 1%, falling nearly 5%, and the Russell 2000, which is small and mid-cap stocks, is down nearly 4%, falling nearly 8%. So if you're frustrated with the market, or that you've topped out at XYZ number in terms of your balance, and now you've just fallen, well, you can't and won't find perfection in investing. Go to these scam universal life policies that are all over TikTok, LinkedIn, and X right now, and yes, they'll claim to you you'll never lose, except you will, because when the market is negative and your interest credit is zero, yeah, you didn't lose money, but boom, policy fees and riders are going to take you negative. All the while, your long-term average is nearly 4% on those, enough to double your money every 18 years. Hopefully, you enjoyed a career of one double, whereas the market has historically done a double in 7 to 10 years. But this is the price of admission. We went from extremely overbought conditions on the market to now getting to extremely oversold really, really quick. And oh, by the way, the amount of new videos on YouTube titled Extreme Market Crash or something like that have come about in the last week, unbelievable. I'll tell you what, if you're trying to just understand the market, stay away from those, because those are clickbait. Those are for the weak-minded people. They've never been right, and they never will be right, even if a big crash comes, because their premise for what a big crash is going to come is all about what just happened, and that does not equal what's going to happen. There. Point is, stay invested, don't freak out, stay focused, and listen to data, not babble. Now let's dive into some actual data. The US GDP number is coming out this Thursday, and the Atlanta Fed's GDP Now model at this point is going to give us an extremely accurate picture of the real-time growth of the economy. Now, my friends, this is one reason not to freak out about our economy. As of right now, the Atlanta Fed says we're growing at 2.9% this quarter, and that is an impressive number for an economy our size, which is the biggest economy. It's proof, despite the interest rate longevity that we might be living with, which is stressing out the markets, that the economy is still in a very, very good place. We're about to find out this Thursday what the actual GDP number is going to look like, and when it's released, we're going to get that look, and then we're going to get a look at the second quarter GDP from the Atlanta Fed next week. Now, I've got bad news on the mortgage market. This last week's inflation data has not been kind in terms of contributing to the interest rates and to those looking to get a mortgage. The 15-year and 30-year mortgage rate are reflecting the reality that rates are going to be higher for longer, and they've made a major trend backwards. The 15-year is now sitting at 6.39% after falling into the 5s a few weeks ago, and the 30-year is now back at 7%, at 7.1%. How about initial claims for unemployment insurance? That number is still staying historically low at 212,000 new claims last week. A great number for this data point. And finally, the markets. The S&P 500, which is our proxy for growth and growth in income, but only when taken together, that was negative 3.05% last week, having a pretty bad week. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was negative 2.79%. And finally, the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, that was negative 1.45%, making it the lowest loser, thus the winner of last week. Now, how about point number 2? On April 17, this past week, the Fed released their Beige Book. This book is released 8 times every year to the public. Now, 2 weeks prior to an FOMC meeting is when it does get released. The Beige Book is a qualitative report on the 12 regional Fed banks, and it contains data that the Fed uses to determine monetary policy and interest rate changes, so it's very important. Contained on this release, in the recent testimony by Jerome Powell, the Federal Reserve will likely postpone its plans to cut interest rates due to persistent inflation. Inflation has stalled out. It's not falling, although we would argue it will. It's just auto insurance. Recent economic data has shown that inflation is not declining as quickly as expected, and that's leading Fed Chair Powell to state that monetary policy needs to remain restrictive for a little while longer. This has led investors to expect a later start to rate cuts, with the first cut possibly now not happening till September, hence all the market drops we've discussed above. Businesses expect inflation pressures to hold steady, according to the Fed's Beige Book. Their survey showed that businesses are facing modest price increases, and many expect inflation to remain steady in the near term. This suggests that the Fed may need to keep interest rates higher for longer to bring inflation down to their target of 2% that they're trying to reach so precisely. Employment has risen slightly, but businesses are continuing to face persistent shortages of qualified applicants. The Beige Book survey also found that employment rose at a slight pace overall, but many businesses are still struggling to find that qualified worker for that specific job. And this suggests that the labor market remains tight, which could lead to wage and inflation pressures, although we have continued to see wage gains continue to drop, which is a good sign for interest rate increases. In the end, the Fed is taking a cautious approach to cutting interest rates, and the Fed is concerned that cutting rates too quickly could lead to a resurgence of inflation. And as a result, the Fed is likely to wait until it is confident that inflation is under control before it begins to cut rates. And that's why Friday's PCE number coming out this next Friday is going to be extremely important to the markets and the near-term movement of it. Point number 3. Here's something we haven't talked about yet. Artificial intelligence, or AI stocks, suffered some pretty big losses last week. They've been pretty much straight up, but they suffered some losses last week, contributing to the decline of the S&P 500 we discussed. Supermicro Computer's failure to pre-announce its quarterly results raised concerns about its AI-related business, leading to a 23% plunge in its stock price last week. The pessimism spread to other AI-related stocks, including NVIDIA, Advanced Micro Devices, and Broadcom, all experiencing pretty significant declines last week. In contrast to the AI-related losses, Paramount Global, the streaming service, their shares did surge 13.4%, and that was because of reports of a possible joint bid by Sony and Apollo Global Management to take over that company. The two suitors are reportedly in talks to make a formal offer for the media giant, which is currently in an exclusive merger negotiation with Skydance Media. And other notable movers we saw in the markets last week include American Express and Fifth Third Bank, which both of those reported better than expected earnings, which is good for that earnings season we're going through right now. American Express's success in attracting high-spending customers with good credit quality helped drive a 6.2% gain in its stock price. And Fifth Third Bank, they had initiatives to increase their efficiencies, and that attributed to a 5.9% rise in their stock price. And finally, point number 4, how about a quick update on President Trump's newly publicly traded company, Truth Social? We saw the unprofitable social media company soar to a valuation of $9 billion right out the bat, which brought a lot of interest from media and investors alike. But without the future growth potential, like a lot of unprofitable companies have, there is little rationale for why that stock was making such big gains, unless explained by a meme stock kind of scenario like we saw with GameStop. Well, it seemed that reality has set in because the stock is now down 65%, still worth an impressive $3.1 billion, and that's giving former President Trump the financial windfall he needs to deal with the barrage of legal issues facing him right now from a very biased legal system. The company currently posts about $5.5 million in sales and about $40 million in losses from operations over the last 2 years. And President Trump owns about 60% of that company. So if he were to sell the stock early to help with these legal fees, which is typically not allowed. You typically have to wait 6 months after an IPO. That could put more pressure on the stock. To be fair, while the recent slide has been pretty dramatic, the stock is still positive 30% on the year, making President Trump's stake in the company worth about $1.8 billion. And according to Forbes, that has actually doubled his net worth. All said, if you were getting excited about Truth Social, I would advocate for signing up for the website, being a member of Truth Social, as opposed to buying the stock at this point, unless you like very large roller coaster rides with your money, because it is probably poised for a lot of ups and a lot of downs still, being that President Trump has so much attention towards him right now and the election coming up. So thanks so much for watching this week's What We Learned in the Markets This Week video. If this video was helpful to you, would you do us a favor? You can do us a favor by hitting the like and the subscribe button. The like button helps push our content out to more people on YouTube, Rumble, and Google through their algorithms, as well as the subscribe button helps our content be pushed out to you as soon as it's released, including our monthly webinars we do. And we will have another one coming out this week all about giving and the most efficient strategies to do giving with. And we have an exciting guest that's going to join us on that video. As well as if you'd like to meet with any of our financial coaches or planners, you can go to the comment section of this video and hit the link in the comments. The link will take you to a scheduling software where you can meet with our coach who will help you in baby steps 1, 2, and 3. Get out of debt, stay out of debt, live debt free, and hold you accountable to those goals, as well as our financial planners and advisors who will help you in baby steps 4, 5, 6, so you can build a plan to save for retirement, help save for your kids' college, and pay off that house early. Thanks so much. We'll look forward to seeing you next week.